the sun, I'm rising up. I feel the love now. Oh, it's in my vision. You know I ran around and I got lost, but now I found it. Well, I can't shake this feeling. Oh, it's gonna take me a little while just to get my head around this moment. But I can see the sun, I'm rising up. I feel the love now. Oh, it's in my vision. And it's telling me run, 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 run. Run, 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 run. Don't give up. And it's telling me run, 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 run. Run, 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 run. And don't give up.
Welcome to the Retirement Learning Lab, where we teach you how to retire without running out of money. My name is Van Richards, and today we're going to cover two really fantastic stocks. Every day we cover a couple of different stocks from the NASDAQ 100, and today is really a significant day because we are on the 50th stock of the NASDAQ 100. So we've covered 50. We've got 50 more to go. We'll go with the two that we have today. So without further ado, this is the daily NASDAQ stock update. The two stocks that we have to cover today are significant. Now, I'm going to ask you to do something today. I'm going to give you some information today, and you may be very tempted to go out and take this information and say, hey, I listened to Van Richards today, and he said that this stock was awesome. I'm going to buy some. I want to ask you to avoid doing that, not because the information that I'm giving to you is contradictory or incorrect or anything like that, but when I give you extremely good stock information, the idea is so that you can develop an overall strategy for saving money. We talk about two different stocks. I don't think that anyone should make or break their saving strategy on two different stocks. You want to make sure that you have a diversified portfolio so that if some of the information that we talk about doesn't work out, then you're not going to be harmed in the overall perspective of everything. And when we talk about some of these different stocks today, I want to talk to you about some of the different things that could possibly happen to a good stock that could make it go bad. Not that they're going to fail or anything like that, but there are circumstances in the world that can cause certain stocks to have certain problems. And there's two different stocks that we're talking about today. One is going to be a chip maker that makes computer chips, and they're a dominant chip maker in the development throughout the world. And then the second one is going to be a software developer for financial software. So let's get right to it and talk about the things that we have to do today. So let me make the screen just a little bit bigger so that you can see everything that's going to be going on today. Now, as I do a lot of times, I talk to you about the stock before I really reveal what the name is. Now, the first stock that we're going to talk about, they develop software for small business accounting. They also offer software for personal tax solutions and also for professional tax solutions. And you may already know what I'm talking about. Let's just see if you do. The first one, when we talk about professional tax offerings, in other words, this company makes software which helps CPAs run their practice. It helps individuals do their income taxes, and it helps small businesses to keep their books. The three companies that I'm talking about all together, there's Lacerte, TurboTax, and QuickBooks, and they are all products of one company, and that is Intuit. Intuit has other products too. One of the name ones is Mint, which I recommend to a lot of people when they're doing a budget because it's a free product that's available to help people to develop a budget. So when we're talking about this particular stock, we're talking about a financial software developer that's dominant in the area of what they do business within. Now, the idea is that we're talking about also is how these stocks fit in with and compete with everybody else. If you've listened to me once, you've heard me talk about three different things. When we talk about stocks, the first thing that we have to talk about is we have to talk about earnings. Then we have to talk about how they compete with other businesses like that, like their own. And then the third thing is we have to talk about the stability of the stock in itself. In other words, how are they fending off the competitors from outside? So let's get going and talk about this just a little bit more. When we look at the price of Intuit over the past year, it started off on 9/11/2019 at 265.61. Today, it ended at 315 even. Over that period of time, it's been a pretty good run. It's been 15.59%. When we look at it in earnings over that time period, and actually we expanded out all the way to 2014. I'm going to go over here and I'm actually going to increase this size just a little bit so you can run up and see what's going on. Now, when I look at the solid line of earnings, I'm talking about what the actual earnings per share is. The dotted line is going to be the estimate. So you'll see that from 2014 that they have actually done pretty good in projecting and actually fulfilling what their earnings are. Now, you may be noting that when we look at this, it has a huge bump in earnings every third quarter. As you look at the third quarter here, the third quarter here, that's because of the type of business that it is. They deal a lot with personal income taxes. So when they sell products, which is around April 15th, then they're going to have a bump up in profits. And that's why we see a big bump up in profits every third quarter. Okay, so let's keep moving on. Another good thing about Intuit is that they have a steady increase in dividends. Every single quarter, they have had dividends, and it's actually for the past 3 years, it's been increasing pretty steadily. And if you've listened to me once, you've heard me say this. There's really only 3 reasons why somebody that's retired is going to buy stocks. Number one is going to be for the growth. And I'm a big advocate of the bucketing system. So if you're going to have a bucket of money that's set aside for 20 years from now, if you're 60, 20 years from now should be an objective of yours for your retirement. You want to have money for that point in time. So growth is definitely something that fits into your retirement strategy. Another retirement strategy is going to be creating dividends. And actually, the 2 companies that we are talking about today have significant dividends. And I love talking about it.
The beauty of your side.
Dividends are a good thing, especially when you're retired, because every single quarter you can count on that money being put into your account. Now, remember that since we're talking about stocks, dividends are not guaranteed, and the past performance is not a guarantee of its future results. But if you are looking for dividends, a good diversified portfolio of dividend-paying stocks could be an alternative to looking for something like bonds. Now, we can't compete with government bonds because we don't have the guarantees that's associated with it. But also we have to understand that most government bonds are paying under 1% currently. So an alternative is looking at very well rated and very well run companies that pay regular dividends. Okay, so let's keep going on. If we look at how Intuit has competed with its competitors over the past year, they've actually done pretty good. Its competition is going to be other companies that do things similar to them. Automatic data processing, which you know more as ADP, is a competitor. And if you look at the chart, if you see the dancing cursor, you see that Intuit's actually increased pretty well. And when we look at ADP, ADP's kind of faltered even after the recovery from the coronavirus market crash. And one of the biggest reasons is ADP has more to do with personnel services, and they don't have really the same type of setup as Intuit does. So Intuit has been more has benefited from people that are staying at home and they have to do their own taxes and they have to do their own payroll. So it's benefited from that standpoint. Other companies that compete with it are H&R Block and also Paychex. And you can see that ADP has been the closest, maybe Paychex too, but let's look at it over the longer period. When we look at it over the 3-year period, Intuit has dominated. When we look at it over the 5-year period, Intuit has also dominated. Now, when we go and look at all of these different stocks, we have to remember that the past performance cannot guarantee what's going to happen in the future. We try as best as we can to strategize, but if you're looking for guarantees, I need to talk to you about annuities or fixed accounts or government bonds. This is not going to be it. Remember, the past performance does not guarantee what the future results are going to be. Now, the third leg in a 3-legged stool that supports a good stock is going to be the company's stability. And one of the big benefits that goes along with Intuit is switching cost. Now, when we look at the stability of a company, we talk about it in the realm of a moat. Now, what do I mean by a moat? If you've joined me before, you know what I mean. This is what I mean. A moat is going to be the barrier that a company digs, let's say, in between them and the competitors. And what makes that moat deep and wide and full to keep the competitors away? And one of the biggest things that Intuit has going for it is the switching cost. If you're doing your taxes with TurboTax, hey, I'm one of those people that does my taxes with TurboTax. And I love the fact that I can populate this year's taxes when I start to do it with everything that's on the cloud. And that's another big benefit, is that Intuit has switched most of all of its services to the cloud. So it makes it much easier for people to use it, and it makes it actually much more difficult for people to switch from it too. Now, when we look at other things that to consider, the reason why that they have a wide moat is the fact that they dominate the market when it comes to payroll preparation, taxes through QuickBooks and also through TurboTax. They have professional services, but they're not as dominant as QuickBooks and as TurboTax. They have about 4.5 million clients, and they dominate 80% of the market. They also have a partnership that goes on with universities. It's kind of unique because what they do is they go to the universities and they give this free software. And so students in accounting are learning how to use QuickBooks. So what are you going to do when you graduate and you've learned how to use QuickBooks in college? I know that I have software that I use in my business that I use through college. The reason is you learn it, you stick with it. So the switching cost is a big barrier. In other words, you got to learn something new, and learning something new is not always the best thing. So that gives it a very high retention rate. The other thing that Intuit has started to do is they have a business matchmaking service, which makes the business more sticky. In other words, if you're doing your income taxes, you can say, hey, I'd like to talk to an accountant, or I'd like to actually have an accountant help me with my books. I'm doing QuickBooks, but I need some help. So Intuit will help to match you up with somebody that's familiar with the software and will help you work through whatever predicament that you have from that standpoint. One of the big barriers, though, that could destroy the way that this company operates is the way that tax legislation works. Back in 2019, there was a tax act that was proposed. It didn't pass, but it's called the Taxpayer First Act. You see, in most developed countries, their tax service, the equivalent of the Internal Revenue Service, does the taxes for people. And what the Taxpayer First Act was for was basically to prevent the government from dictating and for doing people's taxes for them. Now, if we have a different administration, all bets are off. Things could change dramatically. So if the tax system changes, the value of Intuit could plummet dramatically. But we haven't really seen that happen. The tax code, we wish it was a lot simpler, but it's only gotten more complicated over the years, which has actually worked out to the benefit of companies like Intuit. So let's keep moving on and see what else we've got to talk to today. When we look at the value and look at what the fair market value is, I use a company that's called Morningstar for that type of research. And the reason why is because Morningstar does research and looks at the specifics. They look at the technical aspect of the company. And they look, in doing that, they'll look at the earnings per share, the income taxes that are paid from a company standpoint, and peg it from the value based on earnings per share. And based on that, they're saying that the fair market value of this company is really only $304 per share, where today it was trading for $315. So it's not really that far off. It's really only trading up about 3.62% over top of what its fair market value is. And remember that the way that Morningstar gives stars to companies is not based on whether they're good or bad or indifferent. They really give stars to companies based on what their fair market value is. And based on the fair market value that they project for Intuit, they're giving it 3 stars. Now, what I find really interesting, though, is to look at what other analysts, Morningstar's not the only company out there, so we want to get a second opinion, third, fourth, fifth opinion. And in this case, we're looking at what 14 different analysts said about Intuit. And based on that, we see that 8 of them said that it was a strong buy. 1 of them had moderate buy. 1 of them had hold. And 1 of them said, hey, sell it. You ought to sell it. So what's that tell us that everything is on this company? We'll get the button there in a minute. They're telling us that this company is a moderate buy, not a strong buy, not a sell, but actually a moderate buy. Now, they do that on a calculation system. I won't bore you with all of that right now from that standpoint, but I want to remind you too that with all the good information that I'm giving to you, this is not a buy-sell recommendation. I'm just reporting to you what analysts are saying. I'm not telling you that you should go out and buy this particular stock. So let's keep moving on to talk about the next stock that we have. So let's say that you are listening to someone give you a pitch about a company, and they tell you, I have a company for you that is the dominant chip maker in the world. They make CPUs and they dominate. They represent 85% of the CPU market that's out there. They're also a technology innovator. They also were one of the very first companies that came up with the idea of Moore's Law. And Moore's Law, here, I'm going to read this to you so I don't get it wrong. Moore's Law is the observation that the number of transistors in a dense integrated circuit will double about every 2 years. Now, if you're in the technology business, you know exactly what I'm talking about. I'm talking about Intel. So let's talk about Intel a little bit more specifically today. They were up as opposed to Intuit, which was down for the day. But when we look at it over the past year, it's a different story. They started a year ago on 9/11 at about $50.44 per share. And today they closed at $49.28. So over a period of 12 months, they're actually down 2.29%. Now, before you go crying in your beer and saying that this is a bad investment, I want you to listen to a couple of different things. This company pays a 2.7% dividend. If you're a retiree, you know that dividends are good. Remember this?
The beauty of your side.
Yep, I love that part. Dividends are good. And I think that you need to remember that if you're looking to create income, you want to look for a diversified portfolio of dividend paying stocks. You can't rely upon one particular company. Now, what I did with my research into Intel is looked at the past quarters over the past 3 years. So let's see how all that works out from the standpoint of profits. I'm going to make this just a little bit bigger for you so that you can see what I'm talking about. Now, when we look at, remember that the solid line right here, the solid line is going to be what the actual earnings per share have been. And then the dotted line is going to be the estimated earnings per share. And if you follow along, you see that the solid line is over top of, has exceeded what the estimated earnings have been every single quarter. And that is the hallmark of a very well-run company. And if we remember, the 3 pillars of a stock are going to be looking at their earnings first, looking at how they compete with other companies, and number 3, looking at the stability of the company. So when we look at the earnings first, the earnings history of this company has been good. So when I talk to you about a company that's paying a 2.7% dividend, you can understand that they've been pretty consistent at paying those dividends. All right, let's keep going on and see what else is going on in here. When we look at the competitors, now this is kind of interesting because some of these competitors I've talked about in earlier shows. And one of the companies I've talked about has been AMD. AMD is more, they have more bargain processors than Intel is known for. Intel is known more for the premium chips in itself, and AMD is more of a discounted. That's changing to some degree, and they're competing. But when we look at the value for AMD, if you follow the cursor, you see obviously what happened here, the coronavirus market crash, and compared to some other companies, it didn't drop as much as perhaps it could have. But when the red, you see AMD has just absolutely taken off. Now, if you remember when I reviewed AMD, we also looked at what some of the insiders, the executives of the company were doing at AMD, and they were selling. And I think the reason why they were selling is because the price of the stock was overbought. Now, on the other hand, we didn't look at what was going on from an insider standpoint with Intel, but I can tell you that this company is undervalued in general. And let's look at it in comparison a little bit more. Of course, it also competes with NVIDIA and also Broadcom. And I think that it actually competes very well from that standpoint. But we have to always remember that past performance is not a guarantee of future results. But this company has a wide moat. Now, I'm not going to play that again for you because you understand what moats are. Moats are what a company digs as a barrier in between them and their competitors. They have a cost advantage. And one of the big reasons that Intel has a big cost advantage is because they're huge. They're a huge company, and it's really difficult to replicate what they do, and the size of the company gives them a significant cost advantage. They also have a significant process know-how. They have an engineering know-how that helps them significantly. The shift to the cloud has been a big benefit for Intel. A lot of people like doing whatever they do on their mobile devices, and using mobile devices has been a big boom for Intel because all the information is stored on the cloud. 85% of the CPUs out there, it's estimated by Mercury Research, 85% of the processors out there are Intel. NVIDIA and AMD are competing from a personal chip processor standpoint, but from the CPU standpoint, they've got a long way to make up. So we talked about the dominance of the CPU market. Now, the other thing is, when I talked about this company from the very beginning, I said that they were a technology innovator. And one of the ways that they have been a technology innovator has been through acquisitions. You can see that the acquisitions that they've had here from 2015, they bought Altera, Nirvana, Movidius, and Mobileye. So they've increased a lot of what they do inorganically. In other words, they've gone out and bought other companies that have technology and they're integrating it into what they do as a company in itself. Now, let's look at what Morningstar says about Intel. Morningstar is going to tell a little different story than maybe what some of the other analysts are going to tell you. When you look at what I'm going to say that Morningstar says, you may be tempted to say, hey, I'm going to buy this on Monday. Remember, I'm giving you information so that you can build a portfolio, not so you can just go out and be a speculator and buy one particular stock. And remember, things can change. Technology can change too. So there's no guarantee that this is going to continue. However, when we look at the fact that this company is currently selling at $49.28, if we look at the earnings per share and take it as a multiple of earnings per share, which is generally about 15 times earnings per share. Now, not to bore you too much, but this is what Morningstar is saying is the fair market value of this company. They're saying that the fair market value is $70. So what that tells us is that this company, according to Morningstar, is selling for a 29.6% discount. Now, you may have looked at the spaghetti graph that I threw up there just a little bit ago and said, wow, this company hasn't performed very well over the past year. Now, what's the objective of buying stocks? Is it to buy when everything's going up? No, it's to buy a stock that's undervalued and make a profit from it. And that's what this stock is doing. But that's just Morningstar's opinion. When you look at some of the other companies that have analysts out there, now Morningstar's given this a 4-star rating, 4 out of 5. So that's really good for their rating system. But when we look at what other analysts are saying, other analysts, I'm going to make this just a little bit bigger if I could, because I want to bring it to your attention. We have 24 analysts that have given us their opinions on what this company is doing. When we look at what the averages are going to be, we see that 6 of them say that it's a strong buy. 12 of them say it's a hold. And then 6 of them, that is 6 of them, are saying, get the heck out of Dodge. This is a strong sell. Now, frankly, I don't see where those other 6 are coming from, because I've looked at this from the standpoint of what's available. And I want to read you just a little bit of my notes on what I did on this, researching this company. They dominate 85% of the CPU market. Now, I mentioned that just a little bit ago. They put in $13 billion into research and development. They're a $209 billion company. They dominate the CPU market. Yes, NVIDIA and AMD are up and coming, but my goodness, how could you say that this company is a strong sell? Maybe if you need to spend the money next week, yeah, it's a strong sell. But if you're looking for a long-term investment, I would say that this is, I don't want to say specifically, because you're going to run out and buy this and say that that was my recommendation, and I don't tell you that. So what I'm going to do is I'm just going to go with this. I'm going to take whatever the averages are on the numbers and say that this company is this. So now you get the opinion of everything that goes on there. All right. When we look at what the average analysts say, they say that it's a hold. And it pains me to put that down there, but that's what the average numbers are. When I look at a company like this and I see that, another thing is when I look at the price earnings ratio is a little bit over 10. As a matter of fact, it's 10.34 when the average market's over 30. How can you say that this is a strong sell? Geez, don't get me going from that standpoint. Okay. Well, that brings me to this point. Just remember that I'm not giving you a specific recommendation to buy or to sell. Now, you may be asking yourself, every day that I listen to Van talk, he says, don't buy this. I'm telling you it's good, but don't buy it. Or he's telling me that it doesn't apply to me. This is the reason why. I can't treat this as if I were giving you specific advice, because I don't know you. I'm a registered investment advisor and I act as a fiduciary. That means I act in the best interest of clients. So When I'm telling you about all this information about stocks, what I'm doing is I'm reporting to you what is available, what knowledge is available. I'm trying to educate you on how stocks work, on what companies do, on what analysts are saying. And remember the three things that we're talking about when we're talking about stocks. We're talking about the earnings, we're talking about the competitiveness, and we're also talking about the stability of these companies. And then I encourage you to build a portfolio and then to put that into practice of saving, building a strategy. And you all do all that on an individual basis, and you work together with everything that you have and build for the future. That is a way that you don't run out of money during retirement. Now, if you want to talk to me about your specific portfolio, then what you need to do is this. You need to go to my website, which is at richardsfinancialplanning.com. And you go all the way down the page, you'll see schedule a call to learn more. And you can schedule a call, and it doesn't cost you a penny. I'll spend 15 or 20 minutes and I'll talk to just about anybody. And we'll talk about your situation. You can ask me questions. And at the end of the call, if there's a basis for us doing further conversations, then we'll set up something. If not, we'll just part ways and you'll have some great financial knowledge that is free to you. So go to richardsfinancialplanning.com, hit the schedule a call to learn more button. You can learn a lot more about your particular situation. So with all that, I want to thank everybody for joining me. Remember that if you're listening to this on the replay, subscribe so that you don't miss the show when it comes out. Generally, we're at 5 o'clock every day. Sometimes we go a little bit later depending on what's going on for the day. And if you missed asking questions and you're a little too shy to call me on the telephone or to set up an appointment, enter a question into the platform. If you're listening to this on YouTube, subscribe, enter a question. If you're listening on Facebook, do the same thing. Twitter doesn't come across quite as much. If you're on Twitter, go over to YouTube, because for some reason the replays on Twitter don't work as well as they do on YouTube and Facebook. But with all that, I'm going to say to everyone, have a really great weekend, and thanks for listening. Have a great day.